Hello again, everyone. It is about 12 noon Chicago time on Wednesday, September 7th, 2022. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Asbury Approach to Investing video for August-September 2022. This is a free video that we produce to introduce professional and private investors to our unique approach to investing and trading the financial markets. It includes some selected charts, ideas, and excerpts from our premium research services. If you like our approach to markets and investing, I invite you to visit our website at asburyresearch.com to get more information about us. For more videos like this one, please visit the Asbury Research channel on YouTube and subscribe. Finally, if you have any questions for us, including services and pricing, please contact us via the Contact tab at asburyresearch.com, or you can call our office at 888-960-0005. So let's begin. This is just a little bit about me. I'll let you have a look at this if you're interested on your own time. The short version is I've been involved with financial markets for over 40 years. I began my career on the floor of the Chicago Mercantile Exchange in 1980. When I was in my early 20s, I spent 17 years there, and that's really the genesis of my approach, or that's really where I'm coming from in terms of markets. We're not coming from academia, but rather a practical approach to investing and trading from guys that used to go to the exchange every day and watch the money moving around the pit. So it's a different approach. It's a very data-driven one, and one that I very much believe in. By the way, if you'd like a copy of this PDF, all you need to do is contact us. Again, the best way to do that is just through our website, asburyresearch.com, and we'd be happy to send you a copy of the PDF. What we do. This is our 17th year for Asbury Research, and what I try to do is simplify investing. I think a lot of people use a lot of jargon, try to make it a lot more difficult than it is. It's actually very intuitive, so I try to simplify. So basically, I think investors are trying to answer two questions. One, should I be invested? And number two, if the answer is yes, what should I be invested in? And that's what we do. When it's time to be aggressive and fully invested, we call that risk on. When it's time to be defensive and protecting your capital, risk off. What parts of the financial landscape are performing best in bull markets and in bear markets, because many of our clients are people who manage other people's money for a living, and they can't go to 100% cash. They need to typically be at least 80% invested in markets. So they're looking for relative performance all the time. Which parts of the market are performing best, as I mentioned, which sectors, industry groups, and individual stocks to buy, where the opportunities are in equities around the globe. Sometimes, like this past 6 months, hasn't been the best time to be in the US. When that happens, there's typically opportunities overseas. And we also track probably about 100 ETFs. We watch the asset flows in those as well. And these ETFs include interest rates and a lot of the commodity markets. So there's always something to invest in. And we try to look at enough parts of the financial landscape, so there's always something to do. Our data-driven models. Again, the longer I do this, the more I believe less in forecasting, and the more I believe in following the money. Sure, you can have your opinion, sure, you can have your idea, but everything is driven by where the money's going in the markets and where it's coming from. That's really what we do well. So we have 6 different models, and we're going to take a look at these all briefly, one by one. But Correction Protection Model, or CPM, is for wealth preservation. The Asbury 6 model is for risk management. Our CEF model, which is an acronym for Sector ETF Asset Flows, is for sector selection. Our CART model, which is another acronym standing for Cross Asset Relative Performance, helps us with domestic asset allocation. Our US versus the world model is for global asset allocation. And finally, our sector and industry group momentum model is just that. It looks at a broad swath of different parts of the market. There's 22 or 23 industry groups and 11 sectors. And we try to measure them in terms of asset flows and relative performance and outright performance to find where the sweet spots of the market are, where ideally when the market's going up, you can have a very good chance of outperforming the S&P 500. So now let's get to the markets themselves and kind of what we're looking at. So we grabbed a few charts and a few models from some of our most recent research reports, premium reports, and dropped them in here. So we can kind of have a look at the status of the market. So price and trend, the S&P 500, ticker SPX, is testing tactical support at 3,900. Here's 3,900 here. That exact support level that we're testing as I look up, we're about 3,950 right now. So the market sees it. So far, it's reacting favorably to it. But 3,915 is this trend line drawn from the June 17th bottom. That's 39.15. 39.08, just under there, is the 61.8% Fibonacci retracement of the move off the June lows all the way up to the mid-August highs, where it failed at this major resistance level up here that I'm circling. According to retracement theory, 61% is the deepest that this move off the August 16th high should go if this June 17th low is going to be a tangible, sustainable low. So I'm really watching the 3,900 very closely, and I think you should too. If we hold 3,900, start to move higher in our tactical models, our CPM and our Asbury 6 turn back to risk on, that's going to indicate a tactical buying opportunity for us. If that's broken, if 3,900 is broken, then we're opening up the door for more losses and maybe a test of this 3,600 area down here, which is where the market stopped back in June. Correction Protection Model, or CPM. We built CPM about 10 years ago at the request of several of our money management clientele that said, can you build us a model just to tell us very simply risk on and risk off? We don't want it to be very active, but we want it to be reflective of the underlying conditions of the market so we can have a better idea of when we should be putting new money to work for our clients and when we should be defensive and maybe taking some money out of the market or certainly tightening stops or maybe looking for defensive alternatives. So that's what CPM does. CPM at its simplest is, and here's some performance data here. This is hypothetical performance data. So hypothetical is looking backward, but we can't see the future yet. So I'm a lot more comfortable in looking back to see what the market has done under similar conditions in the past than trying to rub my temples and be a tea leaf reader and try to prognosticate on what the market might do. This at least gives me an idea of what's happened in the past, and I can make some risk-reward decisions, and I can make some other investment decisions because of that. Since 2011, CPM trading SPY with CPM, which is the ETF that tracks the S&P 500, on average through the end of the second quarter of this year, just this past June, on average, it's underperformed the S&P by 2.2% a year if you take all these and add them up. Why is that good? Because if we go down to this bottom panel, which shows the quantitative metrics of that period, it shows that during that time, it took my beta down from 1.0, which is the assumed beta for the S&P 500, took it down to 0.42, less than half. Beta is one of many different measures of risk. So according to beta, less than half the risk following CPM rather than just buying the S&P and crossing your fingers. If we look at maximum drawdown during this period, the S&P had a maximum drawdown of just under 34%. CPM only had 15%. So for many of our older investors, wealthier, they're more risk averse typically, who say, I want to be in the market because I need to be, but I don't like the risk. This is a way to play the game with less risk. You give up a little bit of performance for a lot less downside risk. So something else that we've done with the model is what happens if we build some of that risk back in. So here we tested CPM, but instead of using SPY, here on the right, instead of using SPY, we used SSO, which is a 2 times leveraged ETF. I am not advocating the use of leverage, but this is a way for me to explain better how the model actually works. So now we're trading a 2 times leveraged S&P 500, and now you can see the average outperformance since 2011 through this past June has been 6% a year. So got a lot more outperformance, and we also got a lot more positive relative performance years. You can see there's more green in this column than there is this one here, which is trading CPM with SPY. Now that takes our beta up to 0.84. Trading CPM with SSO, still less than 1% for the S&P. Takes our maximum drawdown up to 29.5%, but still a little less than 33.9% in the S&P. So two different ways to use this model, and this is a part of our premium package. The Asbury 6 is kind of a companion to the CPM, but the A6 is an indicator. What we found, or what has happened to the markets in our view, certainly over the past 5 years, is there's a lot more day-to-day volatility. You've seen it. You get up in the morning, the S&P's up 50 to open up. It closes even. Overnight, it's down 70, and you're freaking out, and you're not sleeping very well. And then the next morning, by the end of the day, it's up another 50. So very difficult to look at the S&P day-to-day and not to get emotionally involved. And when you get emotionally involved, that's when you lose money. It's very important to be driven by data and not by fear and greed, because those buttons can kill you in the markets, the fear and greed buttons. So here's our Asbury 6. When the Asbury 6 is gyrating back and forth between positive and negative, it takes 4 green of the 6, 4 green or positive to get a positive reading in the model, and that gives you a green arrow here. 4 red or more, it gives you a red arrow. So when you see it blinking back and forth, we call this blinking, it tells you that the market's at some kind of an inflection point, probably getting ready to reverse direction. So you can see from the end of November of last year to the middle of January, a lot of blinking. That was the top. January 14 was that last down signal, and it took us all the way down here into the March lows. And then we had a signal here in green, positive, red, negative. Then you saw a little bit more blinking right after the June 15th bottom. Now on July 1st, we didn't know June 15th was a bottom, but we saw this blinking going on. It suggested to us that this was probably a more tangible bottom, and sure enough, it took us straight up to the mid-August highs. The week of August 23rd, you saw some blinking going on here. That told us this was probably a top, and get ready for a move down, and we've had that move. So basically, going back to CPM, CPM has avoided 6% of this downside so far, and on the upside, CPM caught 10% of this upside. It didn't catch the whole move, but it caught the sweet spot, like in a 2/3 of it, and that's really what we're looking to get. We're not trying to forecast tops or bottoms. We're trying to catch the meat of these moves on the upside and avoid those moves on the downside. So that is the Asbury 6. The Asbury 6 is currently negative since August 26th. You can see all 6 are negative now. So it's pretty demonstrably negative right now, but this is a tactical tool, and this could change in a week. So this is updated on our website every day, and it's a way for us to get the real condition of the market and not whatever the S&P, whatever the algos are driving the S&P to this day or that day. So we're still negative here since August the 26th. Here's a few other charts, things we watched that I think are important for the month of September. This is the NASDAQ 100 up top here, daily since April. NDX is the 100, it's the large cap tech names. Down here is its daily relative performance versus the S&P 500 or SPY. We use the ETF SPY for this relationship. So you can see on July 7th, NDX started outperforming SPY. Tech started outperforming the broad market on a 63-day basis, which is a business quarter, and it's our strategic time frame. That told us to start looking for a bottom in the market, not only in NDX, but in the S&P 500, because we're getting some outperformance now. We're getting the leaders to lead. This was important. That went away on August the 26th, and now we've just started a new move of relative underperformance on a 63-day basis. As long as NDX continues to underperform SPY on a quarterly basis, that is negative for the broad market. Very important to watch this month. Volatility. This is the S&P 500 up top since March daily, and this is the daily VIX also since March. We look at 24 in the VIX, which is the CBO volatility index. We look at 24 as the line of demarcation between a tactical buying opportunity in the S&P 500 and a sustainable market decline. So you can see from July 21 to August 25, it was underneath 24. The VIX was underneath 24. That gave us all of this that I'm circling with my mouse. Since August 26th, however, the VIX has edged back up through 24. And this was after the S&P 500 failed at the 200-day moving average and started to roll down. And we got our signals in CPM and in the Asbury, CPM and the Asbury 6. As long as the VIX stays above 24, in our view, the market is too afraid to mount a sustainable move higher. If it moves back down through 24, especially if we hold 3,900 in the S&P 500, that's going to be an indication to me that we may have a new tactical buying opportunity. So right now it's negative, but you can see it's right on top of 24. It's another one of those indicators that can change in a day or two, so we're watching it closely. Seasonality. I don't spend a lot of time on seasonality except if it dovetails with what I'm looking at in my models and my data, following the data around the board, so to speak. And there are certain times of the year when seasonality is very important. This is one of those. September here in pink is the seasonally weakest month of the year. Each of these columns represents 1 month of the year. Weakest month of the year based on data since 1957. These green bars show that phenomenon, fourth quarter rally. October starts out a little tepid. It's the sixth strongest month, but then we have the first and third strongest months of the year in November and December. So right now, weakness in December, Asbury 6 is negative, CPM is risk off, the VIX is above 24, and tech stocks are underperforming the S&P 500. They all kind of fit together. We're going to really be looking for a potential buying opportunity as we head into the seasonally strong fourth quarter. This is our CARP model. This answers the question what to be invested in. This first half of the year, when the market was down, when the broad market was down, and we were going through that, whatever it was, 25% top to bottom drawdown, CARP was showing us to be invested in value stocks and in low volatility stocks and blue chip stocks over tech. So it was giving us a defensive setup. Right now, through last week, this model is updated weekly. So we're looking at 8 different relative performance comparisons in 3 different time frames. These are the 8 comparisons: stocks over bonds, large cap over small cap, growth over value, and so on. And then our 3 time frames are trading, which is weekly, and that's when we update the models once a week. Tactical, which is 21 days, a business month. Strategic, quarterly, is 63 days, a business quarter. Right now, you're kind of seeing a negative setup here. You're seeing low volatility over high beta. You're seeing large cap over small, another defensive setup. The Dow starting to move, outperforming the S&P. Value here on a 5-day trading and a 21-day tactical starting to outperform growth. This is a negative setup. When the market starts to turn higher, and it will at some point, we're going to start seeing these relationships change. This will help us to be in the parts of the market that are likely to outperform. For me, nirvana is risk off, limited exposure when the market's going down, and outperformance when the market's going up. This is one of the models that helps us find that outperformance. This is our U.S. versus the world model. It measures the U.S. S&P 500 versus 25 different global equity markets around the globe. For the past almost 3 months, it's been all U.S. So there's been no bold green highlighted cells in here. The U.S. was outperforming every one of these things, or almost all of them. And certainly there were no trends here across multiple time frames in any of these overseas markets. But look how many now we have: Chile, New Zealand, Malaysia, Brazil, India, Russia, and Thailand. Just very recently, over the past week or so, we've seen outperformance coming from other markets. I look at that as an indication that global investors are nervous about our markets. That doesn't mean this has to last 3 months through Christmas. This just means right now you're seeing a reallocation out of the U.S. and into some of these foreign markets. It gives me a little more clarity as to what the condition of the market is globally. So right now, you're seeing people diversify away from the U.S. In the first quarter of this past year, first quarter of this year, I should say, when the U.S. was down, Chile, Brazil, and Peru were all outperforming. South America, 3 South American countries were outperforming by a lot, like 30% over 1 quarter. This helps us find those opportunities when the U.S. market's weak. This is our CEF model. Our CEF model also looks at the same 3 categories in terms of time. But now instead of looking at relative performance, it's actually measuring the asset flows, the velocity of asset flows that are moving around the 11 sector spiders. So right now it's showing us that there's an existing trend of inflows into financials and a new one into utilities. Financials since 8/25, August 25th, a new one into utilities. This is where the money is currently going in the sector space. I'd also showing new trends of outflows from energy and technology. That's where the money's coming from. We update this once a week on the weekend. It's available in our research center, which is the password protected part of our website. And what I like about CEF is over the past 8 quarters, it's outperformed the S&P 500 in 7 of them, or 88% of the time. 2022 year to date, it's outperformed the S&P through June now. We'll take another look after this quarter's over, by 13.1%. And what I like even more is over this past 2-year period, 8-quarter period, the beta trading CEF is less. So it's outperforming the S&P with less beta. Beta 0.78 versus a 1.0 beta for the S&P. Max drawdown, only 14.6% for CEF versus 23.6 for the S&P 500. Up capture better, down capture better, total return better, annualized total return better, alpha better. So this is a very good model for those who don't like to be totally in cash. They like to keep something moving all the time, something in the market. This allows you to participate in up and in down markets and still be able to capture that outperformance, or at least be in a position historically where history suggests it's going to outperform the S&P with less beta, with less risk. Finally, this is our CEF model for the past 2 years in green versus the S&P 500 in blue, day to day for 2 years. You can see it overtook the S&P in early 2021 and really gained on it this first half of the year, not because CEF outperformed, but because CEF basically was a relative performer while the S&P 500 got creamed. So through the first half of the year, S&P 500 down 21%, CEF down 3%. Why? Because it was overweight energy from January 24th to January 10th to June 24th, outperformed the S&P by 40% during that period. So there you have it. Gave you a little bit of market outlook. And we also kind of gave you a quick look at some of our models, or most of our models actually, to show you how we use those models to try to protect our capital and stay on the right side of the market. Again, if you like our approach to markets and investing, I invite you to visit our website at asburyresearch.com to get more information about us. For more videos like this one, please visit the Asbury Research channel on YouTube and subscribe. Finally, if you have any questions for us, including services and pricing, or you'd like to request a PDF of the video that you just saw, please contact us via the contact tab at asburyresearch.com, or you can call us at 888-960-0005. Have a great September, and we will see you at the next one.